Welcome back, everyone. I hope you guys are having a fantastic week so far. Today we're going to get into financial analysis.
Super excited. Financial analysis.
Let's go.
How exciting is that?
Very, very, Galen. Because
Yes.
this is how we can determine if they qualify or not.
Okay.
All right?
We're going to have the CI. We're going to, wait, not the Central Intelligence Agency, guys, okay?
No,
I'm
guys,
going to do
not the
background
Central
checks on you guys.
Yes, no. Look, it's credit, income, and assets, right?
Yes. So you got to remember that. Credit, so important. Why is that so important, Louis?
Well, when you buy a property, you have to have some sort of credit, right? You have to have some sort of income and some sort of asset,
Yes.
right?
And now that the credit is damaged, well,
Well, you're going to remove the credit part, right? Because now you can only qualify through income and assets.
yes. Some people have the understanding that, or the notion that if they have equity in the property, they can try to refinance.
Yeah.
But that is not the case when your credit has been damaged.
Well, yeah, and not only that, look, a lot of people reach out to us and say, well, I'm just going to get some hard money. Well, you still have to have some sort of credit, right, to pay it back. And remember, guys, this is very important. A hard money loan is for a short term, not a long term.
Correct. You got to have an exit strategy.
Yes,
and it can
very
be
important.
more damaging if you move forward with something like that at a higher interest, and they're just taking all that equity that you had left.
Yeah, because imagine this. Imagine if you want to get a hard money and your credit is damaged, right? All you're going to do is just pay a higher interest rate.
Correct.
So,
So this is why it's important.
of course, absolutely, it's very important, right? And then there's something called debt.
Ratios. Okay, so debt to income ratio.
Mm-hmm.
So why is that important? This is how we're going to be able to understand and explain how a borrower has the ability or not have the ability to make those mortgage payments.
Right. This is critical, guys, right? There's the mortgage payment can have a PITI, correct?
Yeah, that's principal, interest, taxes, and insurance. So if you guys recall, once again, when they qualified for the property, they had to make sure they could make that payment. But now that they've fallen behind, they're in pre-foreclosure, something happened, health, could be divorce, could be a number of things, COVID, all these things are happening and they
Right.
don't have the ability to make that payment anymore. So when we take that mortgage payment and we divide it by their gross monthly income.
It's good. You got it.
Okay. Now, if they're self-employed, we take the net monthly income and we divide that and we find out that ratio. If they fall within that 35 to 40% debt to income ratio,
Yep.
then we can prove that they have the ability to make those payments and still try to see if we could do some kind of a workout plan with the bank.
Good stuff.
Or loan
Good
right?
stuff, Galen. Exactly the way it works, guys. And this is exactly the way the lenders look at it, right?
So, but if they don't show that ability to make that, if they don't have that income, what's next, Louis?
Yeah. Let's do a scenario.
Yes, let's.
What do you say?
Let's
Let's
do
do
an
a
example.
scenario. Let's say that the monthly payment is $4,000,
Okay.
okay? And the taxes are $500 and the insurance is $150.
Okay. So
Okay.
total is 4,650. I was that fast
Yes.
on the calculator.
Wow.
Good, huh?
Okay. Good stuff.
Okay.
And then
Their gross income is.
7,000.
Okay. All right, guys. If you guys are following with us, do the math.
Yes. So remember, $7,000 is their income.
Okay.
Okay. So now all you're going to do, Galen, is
We're going to take their mortgage payment, total of 4,650. We're going to divide that by their income, and that is going to be your DTI, debt to income ratio,
right.
of 66%.
That puts you over, right? Because we're supposed to be at 40, between 35 and 40. So that puts us over. That's at 66,
Yes.
guys.
So they don't qualify, guys.
Yes.
They just don't. We got to have that heart-to-heart talk with them at that point, right? To help them understand what options they have at this point.
Look, at the end of the day, guys, it's not that difficult to have that heart-to-heart with them because it's all about the numbers. And the lenders are looking at numbers, right? So once you understand the debt ratio and you could have that conversation with them, we're the professionals, guys, right? We're the ones that are delivering the message on how this whole thing works, right?
Correct. Yes. If they don't have the ability to make that payment, then of course, many of them always want to save their home, right? But you must have that empathy and that understanding at this point. Like Louis just said, the numbers do all the work for you.
Yes.
They're going to let them come to that revelation of understanding that they may not be able to afford that property. And therefore, we have to look at, do they have equity, or if they don't, what other options do we have at this point?
Yeah, so if they do have equity, great. That's awesome for the people, right? But at the end of the day, they have to make a decision. And the most, here's the biggest hurdle we go through. Explaining what a financial decision is or an emotional decision, right? The people need to make a financial decision. They have to understand that this property is an asset, right?
Correct. That's right.
So-
It's an investment, and they want to do good by their families or their situation that they're living in,
Right.
and be able to walk away with dignity.
Right.
Okay?
So guys, look, man, if you have any other questions, right,
Yes.
about this stuff, this is the stuff right
Meat
here,
and
guys.
potatoes.
Yes, guys. So look, stay tuned for the next one.
God bless.